Welcome to the Traders Clinic, your regular shot in the arm of trader insights, philosophy and knowledge, brought to you by two professional money managers, Ali Crooks and Charlie Burton.
Every show we answer your burning questions and we cover all things from the world of trading. So we're back.
We are. New studio as well.
Yes, new studio. You seem a lot further away.
I know.
We got used to having
you.
our
I
knees.
miss you over there.
Oh, yeah, have a wave from over here. So we're off. So we've got a really interesting show. The first thing we're going to talk about is the foolproof system that wasn't actually quite so foolproof.
No, this was, someone got in touch with me just a week or so ago and said, Charlie, I've been trading really well for the last year. And you're thinking, oh no, here we go. But, and he said, I'd got my account up to 5 figures. So anything over 10,000. I assume he was based in the UK. And he said, and then literally, he said, with this gold move, so recently, we're recording this sort of middle of December, but I think about a week or so ago from when we're recording this, gold made those new all-time highs. And it was a weird one because it went up on a Sunday night in very low volume, low liquidity hours, like between 11 UK GMT and 12 GMT. It spiked up quite high and then reversed back down. So, and then ended up doing a big old reversal. But he said that spike, he said, stopped me out or blew his account up.
Yeah.
So you're like, okay, so you've got a system, so to speak, or an approach to trading whereby you've been growing this account over this past year and you've got it up to 5 figures. And then it was interesting because you're sort of blaming the move in gold, not his approach. So with a little bit of questioning, soon found out he doesn't use stop losses.
Oh, interesting.
And he said, no, he said, what I do is I put a hedge on once my position goes negative. And I'm thinking, oh, obviously there must be a certain point. And he said, and so what happened with that? Because it happened overnight, he was in bed. So he missed the opportunity to put this extra hedge on or whatever. And the spike itself wasn't that big a spike. So he must have been overgeared at that point as well.
Yeah. And
for that spike to then stop him out, that suggests to me that he had been, as gold had been coming up in the days and weeks going up to that, you and I know what traders do. So he's obviously martingaling. So he must have got into a position, then adds, and then adds, and then at some point probably then puts a hedge in. Because there's no way that in relative terms, it wasn't that big a move in gold. For that to blow his entire account up must mean he was massively over leveraged. So it would suggest, and he said, and it was in the final that last 2 weeks. So it would suggest that he'd been shorting gold. Nothing wrong with being short a market as it's going up if you've got a strategy or an approach for that, but with no stop loss and obviously then getting very, very overgeared. And this is the problem with people that martingale, is that they can get away with it. So you can trade profitably for a year. You could trade profitably for 18 months, 2 years, and potentially get away with it because you might sweat for a while and then gradually, and then it comes back for you. But what about those times when it doesn't? And like he said, well, I didn't get to put the hedge on, but then if he had put a hedge on, it came down quite fast, and then he would have been underwater on the hedge and it would have got really messy anyway. And that's the problem. These sorts of systems always end up falling over and breaking. Yeah. But of course, people attach themselves to the fact that, yeah, but for the year beforehand, I was making money. Yeah, I know, but it's doomed to failure.
Yes.
Sorry, you
No. I think the thing that strikes me, because I remember doing the same thing. I'm waking up and seeing this big candle spike, and to me, there's 2 things going on. It's firstly that the system to somebody like me or you is very fragile. But the challenge is to a trader like that, if he's been profitable for a year, and a year to most traders is a long period of time. Yeah. So they've bought into their system, they've bought into the fact that it's making the money. Whereas, ironically, he's probably just got lucky and he's been playing a move that's been going on for a long period of time. So he's sitting there thinking, well, I'm profitable, this is almost foolproof. And it takes one candle that's out of the ordinary or something that happens. And it's what we always talk about, it's the inevitable black swan event that nobody prepares themselves for because he's not using stops. And I think, so for me, looking at that, it's that idea that, he's buying into martingale, but he's also in this position where he's bought into something and thinks it's almost foolproof because he's had some success. And it's not the first time we've had stories of people that have, you know, run up and done really well. And we've even had scenarios where people in fund management have done something similar and they've made all this money for their clients, but they're running a system that's too fragile, and it just takes one candle, one black swan event that isn't actually that big a deal that gets them.
That's it. It's these black swan events happen way more frequently than you think.
Yes.
And so you think you've got a system, and the thing is, the market does a great job of creating bad habits in traders. So you imagine that trader's going to cling on to 12 months worth of making money and thinking, well, I'll just do a slight tweak, or this probably won't happen again. And he'll probably go and do the same thing again, because he will be attached to the 12 months where he was making money, not the fact that the strategy was doomed to failure, like I said, that approach. In fact, if anyone reads the book, The Hour Between Dog and Wolf even, The Hour Between Dog and Wolf by Steve Coates, I think it is. And they studied a load of bank traders. And during their studies, they found that these bank traders were taking massive risks because it wasn't their money. And even though some of them had amazing returns over 2, 3, 4, even 5 years, ultimately they would always blow up because they were taking too bigger risks and not the risk management in place. So what's the point in making money over 2 or 3 years if in year 4 you're going to lose it all? Now, if you're a bank trader, it's different because you've earned all your commissions. It's not your money.
There's a different incentive.
It's different. But if you're a retail or an individual trader trading your own money, if you're ultimately just going to blow up, what's the point in making that money unless you're taking withdrawals along the way, knowing that it's going to happen? But that's a ridiculous way of thinking about the market
in such a short period of time. And going back to the book, I think I might be recalling this incorrectly, but they said that every year that each of these bank traders were more profitable, their testosterone levels went up, and the amount of risk, their appetite for risk and what they leveraged also went up. And it ties back to something I remember hearing from Nassim Taleb, and I'm paraphrasing, but he said something along the lines of, never give your money to somebody who's had a 10-year successful track record, because the chances are they're going to blow up. And I think
we're screwed then.
But it was slightly said tongue-in-cheek, but it's he's making the point that what happens is you buy into your system, and invariably you don't take less risk thinking, well, I've been successful for a year like your guy, or I've been successful for 10. You in fact take more risk because you've built up this false premise. And ultimately it comes back to the basics, what we talk about all the time. He wasn't using stops.
I think what you've quoted Nassim there, and that's I do find that quite interesting. And it is so true, and especially with fund managers, we see that, especially. You and I are money managers, but I do think, I was only asked this yesterday, about how do you stop yourself from being overconfident? And I think when you trade the way that we do, which is still short-term trading, basically we're in and out of trades within a couple of months, or or a few weeks to a couple of months, that sort of time scale. The market is a great humbler.
Yes.
And the longer you've been trading, actually, the more humble you become. Although at times we can say, oh, look, we've done this or we've done that or achieved whatever. But I still think that the market keeps you in balance a lot of the time, the more experience you have, because it doesn't matter how long you've been trading, there's always going to be something that's going to come along. The market will be like, oh, I'm just going to show Ali here a little lesson, or Charlie.
It does. And I notice with language patterns, the more experienced the trader, if they've had a good trade or an exceptionally good run, their language almost discounts it. They almost say, oh, I had a really great March. Probably going to end up losing in April. They almost are balancing themselves 100%. Out. And whereas with a less experienced trader, they have a great March, and then expecting a great April, a great May. And I think you notice that with traders who have had their asses kicked on a regular basis or been humbled, is that they don't cling on to that year's performance. They're almost going in not negatively or pessimistically. They just understand that it's cyclical, and they're not always going to be winning, and they're not always going to be on an upward trajectory.
One last thing on this topic, and you just mentioned testosterone and elevated testosterone levels. And likewise, when they would lose money, their testosterone levels would go through the floor, and it could take them years for those testosterone levels to come back up again. And that comes back down to our natural fight or flight responses. So we need that element of elevated testosterone in order to put us in the game, in order to click that button and buy or sell. But what we can't afford to do is to be overconfident, because then that leads us on to revenge trading or over trading, especially, and trading too big leverage like that chap. So we do need to find that balance, but we can self-recognize when we are feeling overconfident or whatever. So what we got to be very careful of is not going into that position of massive fear in the market, because that's our testosterone, that's flight or fight.
Yeah.
And we're running away at that point. We're in a dangerous situation. A lion or a tiger's chasing, right, run.
Yeah.
And we're running away from the market. Unfortunately, in the markets, we can't afford to do that.
No.
So one of the ways to try and manage that is manage risk, all those things, because that will help us to stay balanced.
Yeah. Love that. Good. So, question I know you get and I get every time at this time of the year. So I thought we'd address it as we're in December. Is should you stop trading in December?
Yeah.
It's an interesting one. So I get this every year, and I think it's dependent on how you trade. So if I reframe the question, if you're a day trader, should you take a break over Christmas? Well, why not? If it's planned, have a couple of weeks off, spend time with family, enjoy the festive period, great. But as a swing trader, would I stop trading? Would I even close positions? Absolutely not. There's no reason why that this small time period would change. I wouldn't change my approach. So really, for me personally, there's nothing that I would do different because we're in the month of December than I would at any other time, and I think it's pretty much the same for you.
Well, we know that you get to a couple of days before Christmas, and it normally just dies a day or so before Christmas, wherever Christmas is falling, of course, and then that day or two after Christmas or between Christmas and New Year can be very quiet. But like you said, if you're in swing trades, then it doesn't make any difference. If you're a day trader, yes, probably it's not worth it, because the market's sort of doing this, intraday. So it's like sticky as anything, So yes, you might as well not bother. But I do think that people get caught up and they say, for the month of December, should I stop trading?
Yeah, I've had this.
August, I should stop trading in August because it's the middle of the summer. No, there's plenty of August where the markets are moving around quite nicely, thank you very much. And there are plenty of Decembers whereby the markets are moving around quite nicely as well. So it's this, people do get caught up in that a little bit.
Yeah, and they make false associations. So they'll say that to me, say, I don't want to trade December. It was awful last year. December's always bad. And I'm like, is it? Or are you remembering the December that was and forgetting the fact that you've got 5 Decembers where you actually made money? And it's much easier for people to focus in on the thing that didn't work and then justify maybe not trading. And they're not looking at the random nature of what it'll be. Yeah.
Go back, my advice would be to someone, get your charts up and go back over the last 5, 6, 7, 8 years of Decembers and have a look at how the market moved. People, like you've just said, they'll have 1 year's worth of experience, which has no statistical relevance to it whatsoever.
Yeah.
And so at least go back over 5, which still doesn't have that much, but go back over 5 or 10 years and just look at the market, whatever the market is, stock market, let's use the S&P as an example or something like that, or it could be a currency, whatever it is that they trade, and look at how they move. And some Decembers are moving around quite merrily, and then they will go into a little wiggle for about 4 or 5 days. But other times you will see flat, but it's not like a written rule that December's a bad month, like it's not a written rule that August is either.
Yes. Yeah.
So
I think people want to create a linear scenario. They want to be able to put something into a box and say, right, all Augusts are good or bad, or I get it in the summer. Should I take the summer off? No. Why would you take the summer off?
Yeah.
I mean, like you said, unless you're planning a trip, like when we went away to the US, it's like, right, I still had a couple of trades running and I was less active for those 2 weeks but I'd intentionally decided that to be the case because I wanted to switch off for 2 weeks and enjoy our trip. But it wasn't because there was I wasn't trying to find a statistical, Augusts are all bad, so I'm taking them off. And I think, if people can appreciate a little bit more the random nature of how months can be, and like you said, they're always people are always looking to take a very, I'll say people are always, some people are taking a very short sample of time and trying to make that the definitive for the next 5-10 years. And it's something where people, if they expanded their space and time horizon, they'd see that, like, you know, a lot of summers are perfectly profitable, or perfectly good.
I think that in trading, you shouldn't take lots of time off, because if you disengage from the market, you lose that little edge in just how you're interpreting what's going on. So yes, of course, Christmas is a time where most of the world, even if you're not religious, or we're not religious, but you know, if you're not celebrating as a festival, so to speak, but most people, even if they're not, are, for many people around the world, it's a break. It's a time. It's one of the few times globally where the whole world sort of slows down for a few days. And so by all means do that, but don't disengage for the whole month of December, because it's going to take you a while to get back into it properly in the New Year's. No need to.
Especially if it's only your second December. And I'd also question, especially from a swing trading point of view, why would you want to? You know, if you enjoy trading, it's the same. I don't want to be away from the markets for long periods of time. I have no reason to. And there's and logistically, there's, again, with phones and internet, there's no reason to be away. So I think it's something we get asked every year, but I think the same answer is always the same. And then lastly, interesting question this, and it's not the first time we've had this, but I think it's one that's important to come back to. Day trading versus swing trading.
Oh, day trading all day long.
We're here for day trading. No.
This was asked recently, I think, again, and there's this perception, and you've said this previously, this is a perception that day traders must make more money than swing traders by default of the fact that they take more trades.
Yes.
If you've got a higher trade frequency, surely you're making more money. Well, there's lots of offsets against that. In theory, the theory would say, right, okay, if a day trader is taking 20 trades a week, as opposed to a swing trader who's taking 2, then surely the day trader is going to be making more money. That would generally make sense, but there are some caveats around that, and one is that day traders are more likely to make more mistakes.
Yes.
Just by default, just because of the market movements intraday, and they may read things certain ways or get caught up in moves and jump into trades and all of that sort of stuff. So the potential for mistakes, the potential for emotional responses is greater, the intensity is greater. But also a day trader should be risking less than a swing trader. So yes, a swing trader trades less frequently, but they can have a larger position on. If we take that age-old rule of saying, okay, only risk, let's say, 1% of your trading capital per trade. Well, a day trader goes and does that, who's taking 20 trades a week, versus a swing trader who's taking, let's say, 2. Then the volatility on the day trader's account is huge because of the swings. 1%. You only got to have 3 or 4 losing trades, and you're down 3 or 4%. And it swings around. So a day trader should be risking a lot less per trade than a swing trader as well. So it's not as cut and black and white as day traders trade more, therefore make more money.
It comes back to that same thing, thinking in a linear way. It's, oh, well, if I place more trades, I'll make more money. If I do more, and I think, and I've seen this on the swing trading side. So I asked a group of traders who were swing traders, how many of you would like to have more trades? And 95% of them said yes. So I think there's this underlying thing of people wanting to either be doing something. It's this idea of, well, if I'm going to sit in front of my screens for 4 hours, 5 hours, up to 8 hours in a day, I want that time to be productive. So if I've got got that time, I want to be making use of that time. And I always come back to, but if every trader's thinking that way, surely there's some value in thinking the opposite way, which is, maybe even if I'm day trading, I want to be actually trading less. So I think if traders could get rid of this underlying thing of, I need to be busy, I need to be productive, I need to make use of the time, and actually think, I think there's huge value in thinking, how can I trade less? And that isn't just by default, like, right, okay, I'm gonna not take trades that set up, but not have this this need to be filling my time or making use of my time. And I always come back to this idea of, if you're risking 1% per trade as a day trader, that's like being in the boxing ring and getting, you know, a big hit. A swing trader might, in 12 rounds, you know, they might get hit like that once a round, whereas a day trader is going to be in the ring and he's getting bang, 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 and they've got to get back up and place the next trade, and the next trade could come along in 5 minutes.
Yeah.
So they could have 3 losing trades, be down 3% that morning, and then they've got to place the next trade. Well, there's the opportunity for overanalysis, fear, to run away from the market, and then they miss the 4th trade, which was the one that was going to be the one. So it's not just a case of making mistakes. I think it's a much harder discipline to stay mentally balanced and stable, especially if you're risking too much. So by default, yes, you should be risking less as a day trader. So yes, you may end up at the end of the month, you've put in all this time and energy, but the swing trader's made 3% and you've made 3%. And some people like day trading. Some people like that element of being busy in front of their screens. But certainly for me, I know, like you, we started more on the day trading side and have moved more towards the swing trading side, because I like the ability to not have to be in front of my screens, and I like the idea of trading less rather than more.
Well, we wouldn't be able to sit here doing what we're doing right now if we were day traders, because we'd be losing too much potential, you know, opportunities if we were doing things like this. I think everyone goes through a natural cycle in trading, and I just think that anyone who's new to trading, is something that I believe, I don't know, it's my own belief system from being a trader coach over the last 20 odd years. I think that anyone who's new to trading shouldn't be day trading.
Totally agree. Yes.
You don't have the psychological qualities, so to speak, and experience to deal with what the market's going to throw at you. And it's a very dangerous environment intraday if you're brand new to trading. So I'd much rather people who are brand new, by all means, trade off of an hourly time frame, 2 hour, 4 hour, and your holding period might only be 48 hours. But do that. You start going down to a 1 minute chart, you're in trouble.
Yeah, I always say stay away from the 5 minute chart.
Yeah.
I think a lot of it is also stimulated by prop firm challenges as well. I think for a recent batch of traders, you know, we haven't got time to go there this show, but I think
how long we got?
Yeah, that I think stimulates the want and desire to be day trading.
Yeah,
you know,
yes.
And which plays into the hands of the prop firms anyway. But that's probably for another show.
I like that. Right. Well, that's the end of this show. His name's Ali Crooks.
His name's Charlie Burton.
Trade safely out there.